So today I'm going to talk to you about the energy bill of 2012, particularly the impact on renewable generation. So I'll start by giving an overview of the energy bill itself, for those of you who aren't familiar with it, and then talk about what the world might look like for renewable generation in 2020, both under the renewables obligation and under the new contract difference. And all the questions after Steve's spoken. So just a bit of background to Red Energy and Riga. So Red is a specialist economic consultancy working in Europe's power and gas markets. We work with the regulators, policymakers in GB, who work with all the debt on the original electricity market performance inspection back in 2010. And then we're now working with National Grid on the implementation of the ELI energy bill currently. We also work a lot with project developers, investors in renewables and thermal generation assets, and working both on the financing side of project price forecasts and also on the optimization side. So, Numeritas Partners is a new partner we recently merged with. Since April, we announced essentially we merged in April. So bringing the large organisations together, we're around 250 people working across energy, commodities and financials. So just set the scene, I guess. I'm sure many of you have seen this before, but we've got legally binding requirements for carbon emission reduction and for renewable development. So for electricity renewables, we need roughly 30% by 2020 as the government's interpretation of the EU target of 15% renewable energy by 2020. And we also have legally binding targets to decarbonise down to recommended level of 50 grams per kilowatt hour by the Community Climate Change for carbon budget. So that's the context for electricity market reform overall. So what do we mean by electricity market reform? What's in the energy bill of 2012? Well, we've got four pillars, four mechanisms within this. I should say first, the carbon price support is really implemented via the budget. The other three are coming through the energy bill 2012. So we'll be talking mainly about contract differences. This is a new low carbon support scheme for sort of renewables, CCS and potentially nuclear. And that's going to function as a difference payment against the power price to be appearing because long-term revenue certainty to low carbon generators might face higher upfront capital costs. Within the bill, we've also got the capacity mechanism. Design this is a little bit further behind, probably in the details still to be worked out. But there's one of the government's aims to tackle these is to ensure secure supplies in the future, and this capacity mechanism is a way they tend to tackle that. Carbon price support is a tax that's been implemented already. The initial performance standard is something that's going to restrict the operating the emissions of new CCTs, but potentially have very little impact over the time we're looking at. So in the day we're certainly concentrating on the contract difference. So a little bit more detail as we go through. So just to give you an idea of the timeline of this, so the four DMRI paper which had the consultation, now have a draft energy bill published in May. It was probably seen this week that the Energy and Climate Change Select Committee recently published its views on the draft energy bill, which is quite scathing. That will now work its way through Parliament and into Parliament autumn and work its way through Parliament. With the idea being that we can have implementation of electricity market reform 2014 with first CFD being signed 2014. The bit of updates here, so the first capacity auction, the capacity mechanism made in 2015 for delivery of capacity in 2019. And importantly, the renewables obligation, of which renewables is currently subsidised in the UK, will be closed in 2017. So what we've got an overlap period between SIF, we are currently in SIF, because that may be quite important to some developers of projects over the next few years. Obviously by 2020 we're aiming for 15% of energy source from renewables. So just drill down a bit more detail into the contract difference that will be created by energy bills. What we're talking about here is a potentially 15-year contract for individual renewable projects, which will be paid a difference payment based on metered output of that project. The idea being that the generator is still selling its power into the wholesale market, that's receiving a top up that is effectively over the long term receives will take a fixed price of power output. So key to that is the reference price for which the contract is struck against. So we make a different where we assume power is being sold in order to make that payment. And we'll talk on the following slide about how that differs between intermittent and base load. The strike price itself is very important. So this is effectively the long-term certain level of the CFDs of the price we're aiming for. But it's always set initially by administratively, so it's set by analysis of the long-run levelised costs of the different technologies, offshore wind, biomass, and with the intention being that the longer term government moves to an auction mechanism that equal across low carbon technologies. It's important to note that for nuclear, the process will be in bilateral negotiations, at least for the first nuclear project. So for renewables, the allocation of these CFDs is the aim is to have a systematic allocation process, which will be limited by the amount of money effectively that the Treasury is prepared to spend on renewable levy cap imposed. And that's actually something that was criticised by the Energy and Climate Change Subcommittee. So the other point that's been come out that's controversial is the contract counterparty, which would be originally the discussion has been on the balance sheet of the contract with the government. The aim now is for it to be the risk to be shared across the market in similar ways to the current balancing settlement arrangements in the GB wholesale market. So rather than as one collectively, I think there's some concern about how that will work in practice, but certainly the intention. So that's the details of the contract difference. What's going to be very important to this contract is the way in which these payments are made and what that means for risks of renewable generators, low carbon generators. So the aim is that generators should recover effectively fixed payment per megawatt hour as output. But we'll do that through selling power into the market, as is shown on this little deal of varying power prices, and either receiving or paying back money based on whether the reference price is lower or higher than the strike price. So it's very different to current renewables obligation, where the generators being paid to get a fixed top up to the power price. So that different risk is also changed for the concerns, I guess, the risks that the generators are facing. So for intermittent generators, for onshore wind and offshore wind, the idea is to use reference price, so this is a day-ahead hourly price. So receiving the generators we're forecasting a day-ahead state that we expect to be generating, and we're trying to sell into a market which is set of hourly prices, and we're receiving payments on that basis. And for base load generators, it's nuclear, there will be a year-ahead price, given more predictability in their output. So the reason for the hourly day-ahead price for intermittent is because it's aiming to take away the risk that your output is very different. Your output is very different from the base load output, and you will receive a basis risk between what you sell into the market and what you receive from different payments. So the idea here is that This is close to real time, so it's close to the basic risks of development can go without making it into a fixed feeding tariff. It does leave some risks with the renewable generator, which is to do with forecasting output at the day-ahead stage. So, just moving on to what we might look like in 2020. So, we've got a couple of outputs from reference value renewables report, a reference case. Looking at 2012 in terms of capacity, 2020 is the way. What we see is the closure of coal plant VLCV, which is red, closure of some of the existing nuclear, a bit more CCT, and importantly, increases in renewables and offshore wind and biomass, increases in capacity. And that change in capacity mix leads to change in prices, change in price shape, which is quite important for renewable generators. The following slide is showing what we may see as an impact on price capture for renewables. So, just to explain this, we've got the average capture price. This is 100% represents the base load price in that year, and lines here showing the percentage of that price that a wind generator may capture. And what we see is that right now we might expect to get slightly better than base load price, simply because we're producing more power from in the winter than the summer prices tend to be higher. And as we get more and more wind in the system, it's under the RO, you've got exposure to market prices, to power prices. You're also receiving a fixed top-up, which is a ROC, or a fairly stable revenue. Now, we find this at the moment, those revenues are bundled into a PPA, power purchase agreement. The reason for that really is to provide a route to market for power, to provide services such as managing the forecasting and balance risk, which the PPA offtake is a better place to do. And as discount may also cover this, it's price cannibalisation, where as we showed, you may be receiving a lower price for power than the base load on average. So that's the world today, and that's how our onshore wind projects are operating. So we move to a contract with difference. So we've taken away the long-term power price risk through this contract, because the power price in 2020 is much lower than it is today, the top end will be much higher. We do have a short-term power price risk, a short-term revenue risk, based on the forecasting the volume of output day ahead. Because for a perfect hedge, the generator has to be able to sell exactly the right volume into the reference market that they're going to receive in CFD payments. If they get there, there's a difference between what they forecast and what outturns, there's going to be some basis risk there. We also have to consider what their route to market is going to be. CFD is going to provide a route into market. It may well be that we're expecting that banks are going to still require some form of offtake agreement for the power. That's something the government's now raised a call for evidence on this point. They want to understand whether the PPA market might actually dry up for CFD generators, given the there's no longer the ROCs going with that. Now that's an open question and one to be debated, but I think there's certainly a concern that could be a problem for CFD. So we just want to finish really with the impact of what risks different renewable generators now are exposed to in the contract. So I think we can see that if the gas price increases and it flows through to long-term power prices, then we see under renewables obligation, generators benefiting from that. Under the contract, the difference, the generator is neutral. Power price volatility, well, under renewables obligation, you mind prices are more volatile, but under the contract difference, that makes it more difficult to sell into the reference market, and there's more risk associated with getting your forecasting wrong. So that's a new risk. The wind cannibalisation, so for getting a lower price than the base load price, we see that whereas on renewables obligation you're exposed to that risk, depending on your PPA structure, and the contract for difference, that's going to go away effectively. So just to summarise, we know that the energy bill is going to change the landscape of renewables investment. It's quite a different model here, and we've got some valuation of these projects is going to require a different approach to modelling, both for a market but also of financial modelling. And it's obviously interesting that we've got potential optionality in the incentive regime that is picked for a generator between 2014 and 2017 in terms of the risk profile, the exposure portfolio to. I think that's something that Stephen will say a bit more about. So I think the final point really is that clearly the basis valuation, the financial models themselves, are going to need to adapt to this change. I think that's probably the best point to hand over to Stephen.
All right. Yeah, thank you. What the new regime is like to look like. Now I'll talk about some of the issues around modelling that and how we might be able to deal with them. So first of all, quite a few of you are probably quite familiar with renewables models, but I thought I'd just touch on the anatomy of a renewables model, what goes into it, and the sort of output that you can expect. So I've divided it into 4 sections here. We've got revenue drivers first of all. You've got a generation forecast, which I'll come on to in a moment. Who's familiar with P50 and P90? I expect everybody's got hands up, maybe? No, quite a few. Yeah. Okay, so I won't dwell on that too much. We've got the energy prices that are going in, the just number of rocks available, and the price that you can expect to get for those, and LECs as well. Now these are forms of subsidy for anybody that's not familiar with them. Obviously, CapEx, the construction cost is a large element of the construction cost, and renewables projects are very capital intensive, so that's significant. Then there will be some fees, and that's design fees, engineers fees, etc., and grid connection. The operating costs, so once the facility is up and running, we've got typically land costs, grid costs and so on, and maybe community payments. And then obviously the other big element of cost is in financing, and how much of that is equity and how much of that is debt, what the repayments schedule looks like, what sort of cover ratios and covenants you have to meet, and whether or not you're going to try and refinance once the facility is actually operating. So essentially what I'm saying here is that's quite a lot of different variables, a lot of moving parts there. And so really a model, the idea of a model is that you can then examine those and try to make some sense, to make some decisions based on some sound judgment and some real figures. So I said I'd quickly mention P50 and P90. This is a not perfect normal distribution here, I know because I made it. So if this curve here represents the amount of generation that you could expect to get, this is a confidence level of 90%. That means that the forecast says that with a 90% certainty we think that we'll generate this much power, or with a 50% certainty we think we'll generate this much power. So that's what those two figures mean, that's where they come from. And those will typically be used as one of the key inputs to a model. So why two different figures? I suppose really that you'll have a worst case scenario, and typically banks will look at a 90%, P90 figure. So one of the outputs from a model may well be something like this. So you've got a timeline along the bottom here, and we've got the interest that you're paying on any debt that you may have taken out. You're paying principal on from cash flow, And these repayment schedules are very often set according to, so this line here, I'm sorry, missing. This line here, the debt service cover ratio, is very often the role of the model is to sculpt the debt repayments in order to keep within a certain debt service cover ratio. And so that sets how much you should be able to pay back on the debt. So you can see this goes out to the end of this timeline. If we were, that's under a P90 scenario, let's say. If we were to look at a P50 scenario for the same thing, then we're getting more cash in, so we can usually pay off the debt quicker. We may well have some cash sweep here at the end. Our debt service cover ratio is likely to be higher because we're getting more cash in as we're generating more electricity. So that's one of the sort of real fundamental scenarios differences that you'll look at using a model. And one of the purposes is, as I say, to set the debt repayment schedule. Just recapping quickly on what Nick was saying about how contract differences might alter the world. So this is taken from a deck document, in fact both of these are, that there's a strike price at which the generator can expect to receive that price for their energy, and if they go above it, then they'll have to actually pay back some money. If they're below it, then they'll receive a subsidy. And so that, as Nick says, removes a lot of the long-term risk. Then we've got this graph which is just showing that there's still incentive to try and negotiate a good price, because actually you get the difference based on averages across the market, if I understood that correctly. So let's take a look at how things stand now and how they would be under contract for difference from a modelling perspective. So I've divided this again into four, this time political, economic, technological and financing. So under the current regime we have ROCs, so these are kind of the big risk items, if you like, the uncertain areas that you have to deal with in a model. So how many, so this is driven by political considerations, permitting, whether or not you can actually get your facility built, permitted and so on. On the economic side, the energy price, the rock price and lead price all have an influence, and that's where over the long term it can be very difficult to forecast. This is why we have firms like Redpoint who try to help forecast those things. We've got technological issues that could crop up, and we may want to model things like a delay in construction, generation forecast we talked about just a moment ago, whether to assume a P50 or a P90, and that's, or sometimes P75, but there'll be different scenarios that you'll need to consider. What about some sort of catastrophic events like technology failure? And of course also, given the generation forecast, how that actually converts into the amount of power we can generate. And then on the financing front, I'd say debt equity ratios, we've seen those shift quite a lot over the last few years, and they did take a steady path downwards. We have seen that starting to recover slightly lately. Fees, however, seem to only ever go one way, and that's in the bank's favour. And the covenant levels, again, they seem to be getting tighter, although it's perhaps again a little bit of relief there. So if we look at what are the important things under contract for difference, some of them are the same, but we've now got a strike price, a reference price, still permitting as an issue, so that's one thing we're going to have to deal with differently. On the economic front, it's now a lot of the risk is shifted to being short-term forecasting rather than long-term forecasting. So the day-ahead price is going to become very important, and there is a risk that we may either over-commit or under-commit. So when we're forecasting what we're going to generate tomorrow, the forecasts are uncertain, and we're going to have to commit to contracts. So Obviously, there are going to be situations where we may overcommit, so we'll generate more than we actually will, or undercommit. And so, if we overcommit, then we may actually need to buy energy on the market or find some other way to make up that shortfall. If we undercommit, then we're going to be generating excess, and we may need to find some way for that, that we can sell that. Is there a demand for that? On the technological front, the forecast of that becomes critically important to try and get that right. Same things apply in terms of how we convert that into actual energy from a wind or solar forecast. And we still have things like construction delays to deal with. And under financing, we've got much the same sort of things, although a couple of new ones here. We don't know what the timing will be on contract for difference payments. We're just doing some work in the Irish market, and they have a similar kind of subsidy to contract for difference. They actually have to wait 2 years before they get that subsidy back. And that's having huge implications for working capital, and to have extra facilities to fund that in the meantime. Also, I have read a question about whether CFDs will be treated as derivatives and therefore will have an impact on balance sheets. That's something that the accounting profession will no doubt be mulling over. So a few differences that we'll need to deal with there. So looking at this overcommitment and undercommitment issue, the ways that we may be able to deal with that are that we could buy energy on the spot market. We would expect that, both for over and undercommitment, that there may well be some financial hedging instruments appearing that will specifically be designed to deal with that, but naturally at a price. One approach might be to, rather than just having individual projects that's just wind farms, just solar or something like that, maybe taking more of a portfolio approach could be an option. So you're actually sort of structurally hedging yourself, maybe having some biomass that is quite often at the moment treated as base load, but having that as an option to make up any shortfall. And of course there's the panacea, which is storage. And of course, if storage can be made to work effectively and cost effectively, then when we're undercommitted, we can store that excess, and if we're overcommitted, we can draw on that. Under the undercommitment scenario, one option is not to generate, but of course that's a missed opportunity and wasted revenue opportunity. Also here we've got the question of whether whether we can still have private agreements to sell electricity into to a private company, and it sort of begs the question: will PPAs be around under CFD, and what sort of terms will be available for those? And I think there's quite a bit said about that in the reports over the last couple of days from the Climate Change Committee. That it might favour the big six rather more than anybody else, and so that could make it difficult to get PPAs. So, if you're setting out looking at building a renewable facility, what are the key things you're going to have to deal with? And between now and 2017, under the draft proposal, you can either opt for ROCs or for CFD. Now, ROCs are well understood, and most projects that are currently in development will almost certainly go ahead with ROCs. But at some point, you're going to have to start to think about whether CFDs might be a better option, or at least as you get close to 2017, and allowing for the possibility of construction delays and so on, that you may be forced into CFDs, so that is going to have to start to be modelled at some point, and have to start putting forecasts on that basis. So it may be a question of trying to decide between the two to that point, but certainly from a risk management point of view, if you're go live date is starting to get towards 2017, then you really need to look at the CFD scenario just in case it doesn't complete on time. With ROCs, we have the benefit of experience, everybody's comfortable with that, they know how it works. The risk is on the long-term energy price. On CFDs, a lot of that long-term risk, as Nick said, is removed. But there are some new operating risks involved, and there's perhaps some more short-term operational risk that needs to be dealt with. Obviously, when you're planning a project, you need to model that. So some new assumptions are going to have to be made about how that impacts the forecasts. So how do we weigh up all these multiple uncertainties? Well, that's kind of what models are for. So one way might be to look at a portfolio approach, as say. So it might be that we need to start modelling portfolios of generating facilities rather than just standalone ones, and you might find that there's that starts to happen with umbrella companies with SPVs maybe for each individual one. Who knows what the structures will be? I'd say I've probably got more questions at the moment than answers on these sorts of things, but we can talk about that. Maybe combining technologies or having them sort of co-located so that you're less dependent on the reliance of one particular technology. Certainly scenario modelling, which is done now, will continue, and we'll be looking at whether projects are viable by looking at different variables and what the impact of those is. But as we saw at the beginning, there's an awful lot of them, a lot of variables to deal with. So how can we deal with more than a handful of variables? We get so many outputs at the end of the day that you just don't know which ones to look at, which ones to focus on. I don't know if you've heard of the technique of Monte Carlo simulation, but that is one possible way. The idea there being that for each of those variables that are important, you would assign a probability over the range of values that you think may occur, and those are your range of inputs. Obviously, each time you run a model, you can only use one of those, so you have to run the model many times, typically several thousand times. And then you record the key outputs, and that might be enterprise value, NPV, or something of that sort. And what we get out is a probability distribution of possible outcomes. So in doing that sort of thing, you start with the qualitative analysis of what are those variables that we need to deal with. Then you look at what are the values that we might reasonably expect the range to be, and what are the probabilities of those occurring. Then you build those into your model, and then obviously this decision making comes at the end. And what you typically get as an output might be something like this, with a frequency distribution on something like NPV. You can see any of the key outputs from the model can be recorded, and you can get a distribution like this. And then there's a point at the threshold, if you like, at which this becomes viable or not. And so then, as always, we're looking at the risk. Do we think this is a realistic risk that we're going to be down here? Another output of this technique is that it looks at the correlation between the inputs and the outputs. So you can see which of the input drivers are the ones that have the biggest impact, and whether it's positive or negative on your output. So that can sometimes throw up a few surprises. And the things at the top, this is known as a tornado graph for obvious reasons. So the things that have a large impact on your output are the ones that you really need to focus on and try to be most confident in. So that's a bit of a whirlwind, not too much of a pun, trip around how we might deal with some of the issues for modelling. As I say, there's a lot of questions arising, a lot of things are still moving around, but we do hope that, that we'll be able to come up with appropriate techniques to help make those decisions.